Hello all. Am I audible, Priya?
Yeah, yeah,
Yes, sir.
Yeah. Thank you all. I welcome all members for our session on Professional Development Committee session. So I welcome on behalf of our Professional Development Committee, Hansraj Chuk sir, Vice President of our Professional Development Committee, and our today's speaker, CA Sampath sir, and other members. Warm welcome to all of you on behalf of Institute of Chartered Accountants of India Professional Development Committee. My name is CA Sachin Phadke. So I have been given the task of hosting this. So I welcome you all and good afternoon. May I please request CA Hansraj Chuk sir to address our today's speaker and the meeting. Over
yeah,
to you, Hansraj Chuk sir.
yeah. Thank you, Sachinji. Thank you very much. At this outset, I welcome each and every participants around us. Naturally, this is a subject which is being known for giving benefit and handhold to many those who need the funds and the structural working of the NBFCs as per the regulator Reserve Bank of India and many newer things which we can really understand through the this webinar. And our well-known and the star speaker around us is Manish Sampath ji. He is already there around us, so he'll be taking us through the journey or through the better understanding and how futuristic will be bringing out best of the economy by way of the contribution from the NBFC sector and the banking sector, those who are part and parcel of the financial structure of the country. And naturally, the Sachin Phadke who is around us to as a moderator or take this session forward whenever the intervention or whenever any support required by the participants, so they can write on the chat and naturally the question will be taken care. Thanks to the PDC team as a secretariat, Priya Dugal with us on the back end and the tech support really giving us to each one of us. I welcome each one of you, each and every participants, and that today's this program is well designed because if we really understand, it's not limiting to the banking and the financial institutions, those who support to the economy, not limiting to the sectors which we talk about the industrialization, but many a time we think of even the you see like sometime individual or the smaller SME sectors, they need the support which bankers may not be able to lend with. So then naturally NBFC sectors come at their rescue. And how the NBFCs are being regulated by the RBI, those are the many issues around us which we today will be learning from our learned speaker Manish ji. But obviously the participants which are there in the thousands from all across, not limiting to a particular place, but all across India, and some maybe from the overseas, those who are really been interested into, because you see like many a time we feel like India is the hub of the chartered accountant, but the Indian chartered accountants, more than 40,000, 10% of the whole lot of the chartered accountants are the they're in the overseas also. They are also being benefited through these kind of the webinars, because technology has brought us close by, and this technology advantage has been well taken by the ICI, the different committees, PDC also leveraging this technology to the best of the manner. Every week, at the same time, we are having these kind of the programs, and the participants are growing with leaps and bounds. And thanks to my chairman, Mangesh Kendreji, who hails from Mumbai, Thane. Today he could not join because of his engagement and the busy somewhere else as he is traveling. So on his behalf also, and on my personal behalf and on behalf of the PDC as a whole, I welcome each and every participants. I welcome the speaker and the moderator of the program too. So with this initial remarks, I'll be back to Sachin Phadke, who will be taking ahead with this program. Sachinji, over to you now.
Yeah. Thank you, sir. Thank you, Hansraj Chuk, sir. And it's been a great honor for me to welcome our today's speaker for the session, CA Manish Sampath, sir. To give a formal introduction of his, CA Manish, sir, is a commerce graduate from Bombay University and a chartered accountant, practicing since more than 27 years. He has joined CNK and Associates, which is a LLP, as a partner by merging his individual practice. He is part of the audit and assurance practice of CNK and specializes in attestation functions of banks, NBFCs, foreign multinational startups, etc. He has been a part of many study groups and subcommittees under the Auditing and Assurance Standards Boards and other committees of the Institute of Chartered Accountants of India. He is a contributor for the revision of guidance note on bank audits and is part of the expert panel to address the queries of members regarding bank branch audits. CA Manish sir was the president of Bombay Chartered Accountants Society in 2019-20 and currently is the chairman of Accounting and Auditing Committee. He has co-compiled the publication Mandatory Accounting Standards from Published Accounts, jointly published by BCAS and CCH, and FAQs on accounting standards. He is the honorary secretary of the Audit Committee of Cricket Club of India Limited. He was a past managing committee member of Western India Automobile Association of India. He was a faculty at the HR College of Commerce and Economics for many of its professional courses, and he has also given guest lectures at various management institutes. He has delivered lectures on various topics of professional interests and practice implementation. So today we have such an eminent faculty speaking on the subject NBFCs and professional opportunities for CAs. I do hope that this will be a great learned session for all of us to get the inputs of CA Manish Sampath sir. I now again welcome him to our today's session and ask him to preside over the session. Over to you, Manish sir.
Thank you. Thank you very much, Sachin. Is my word, am I audible properly? Can people hear?
Yes. Yes, sir. Yes, sir.
So, good afternoon. First and foremost thing, thank you, Hansraj ji, for inviting me. It's always a pleasure. And you mentioned about Mr. Mangesh Kinnare. He's also a very close friend of mine, since you said that we all, both are from Bombay City. So when he called me up for this session and he just told me, Manish, tere ko yehi topic pe bolna hai. So I was quite thrilled and happy, because this is what we practice day in, day out. So thank you, Sachin, for your kind words. And as Sachin also, introduced me, that I am more preliminary into statutory audit function. But yes, we do audit for banks and NBFCs. Besides that, we also do audit for other manufacturing service industries, foreign multinationals, etc. So whatever we will be discussing today in the next 90 minutes or so, I'll just first share my screen, and then is my screen visible?
Yes, sir. It is visible.
Yeah. Yeah. So the topic that has been given to me is professional opportunities and the NBFC sector, or rather, NBFC sector and the professional, opportunities therein. And just want to start off with a disclaimer that these are my personal views and not necessary views of the firm or the institute. And the canvas that we have today for the next 75 to 90 minutes, we'll have some time for some question and answers also. So what I will be covering first is, sorry, excuse me. What principally is the NBFC? What is an NBFC? What are the principal, business operation tests that has to be passed? What are the various regulations, strict regulations revolving around the NBFC sector? How RBI controls the NBFC sector? Its regulations around it, the latest developments that are happening in the sector, what is the new regulation that has come based on the scale-based regulation, how the Reserve Bank of India is looking at NBFC like a bank itself only and wants to, stricter regulator an NBFC. Then besides that, I have some statistics, some slides from RBI report, which shows you the importance and the growth of the NBFC sector, the importance. And then on the various opportunities for a professional or for a chartered accountant, which is there besides statutory, internal audit, consulting, tax, etc. There is a host of other services which we can, interact with moving forward. So first and foremost thing, what is an NBFC? Naturally, an NBFC is a company which has to be registered under either the Companies Act 2013 or under the 56 Act. It cannot be a partnership firm, an LLP or trust, etc. It has to be a company, and it has to be engaged in the principal business of either giving a loan, lending. It has to be a financial business, that's the business test that is there. So either in giving a loan advance or acquisition of some security, shares, etc., or in in leasing, hire purchase, etc. But not it's into trading of goods, etc. So basically, financial activity is what the company is involved in. Then, even though you can have an NBFC where there is a company which is into some other business activity and then wants to convert into a principal business activity, then how do you calculate or how do you determine the principal business test? So this, friends, is commonly called the 50-50 test, which has to be determined whether the company is principally involved in financing activity or is in dealing in financial assets or consumes an NBFC or no. So the 50-50 test over here is most important, that if a company's principal business activity is from financial assets or from lending loan or from investment, more than 50% of its total assets and 50% of its total income, then it qualifies to be a principal business activity. If, for example, if the assets from investments into mutual fund, investments into giving loans, etc., investment into share constitute 51%, that is, it breaks the test of 50%, but its income is less than 50% because it might be having some rental income from somewhere, then it is not qualified for 50-50 test. Here, it has to, at both ways, it has to pass the 50% test. So therefore, this company does not include, companies which are engaged in agriculture or other industrial activity, etc. It has to be preliminary from finance activities. So friends, here to be, informed, live examples that I can show you or, share with you is that what happens that, the company is a running company and it has investment, it has surplus funds and it has investments in mutual funds, etc. and shares, etc. And it has got some investment in property also, office properties or office premises. And since the office premises are purchased long ago, so therefore its value would not be that much that would constitute more than 50%. So therefore, naturally, the investments in mutual funds, shares, etc. would be more than 50%. But in 1 year, these properties are all given on rental and the rental income is coming, which exceeds 50% of the total income. So therefore, it does not fall into an NBFC. But I had come across a live case wherein one such company run by a widow lady, the husband had died, the director had died, and it was the only source of income. And in 1 year in COVID, that rental particularly stopped. And then what happened is since the rental stopped, both it breached the 50-50% on both, on income also and asset side also. So then does this company qualify to be an NBFC? Because we as a statutory auditor in CARO also we have to report whether the company is qualified under 45(1) of the Reserve Bank of India Act and needs to be registered as an NBFC or no. So in this case, what do you do? Is the intention or is the principal activity of the business as financial activity? I would say no, it's not the case. But since it has broken the 50-50 case, so what we need to do is either we have to inform the RBI saying that this was a 1-year aberration, etc. And therefore, this should not be construed as the management does not, does not want or the management is not intended to carry out the financial services or financial activity, etc. So therefore, it is not required to be registered under the NBFC criteria. So the letter has to go from management, and then we in our audit report have to make an adequate disclosure, etc. about it. So therefore, these are my views. However, also many such companies face with this dilemma, and we as auditors sometimes, in the rush of our audit or just to see completion what was done last year, we try to oversight this particular fact. So we as auditors also need to see whether the 50/50 test has been broken for each year or no. And here also, I believe that there is some clarification from the RBI that RBI does not consider bank fixed deposits as financial activity or financial assets, because it may so happen that pending deployment, the bank or the company, operating company, might have just parked temporary funds in bank account, either in bank fixed deposits, etc. Then they do not constitute as a financial asset, and it constitutes as a non-financial asset. So that is one point that needs to be kept in mind. Then if we discussed that, yes, the main function or the preliminary business of a bank is financial activity, then what is the difference between an NBFC and bank? An NBFC can also go ahead with investments, and NBFC can also give loans, etc. Then what is the difference? The only difference between, I think, I mean, of course, the activities of both the banks and the NBFCs are similar, but banks are just now allowed to issue checks to its account holders, and the issue checks drawn upon itself for and also be part of the payment and settlement system. But NBFCs are not allowed to do so. So that's the major difference. The second difference is that the NBFCs are not allowed to accept demand deposits. Like, for example, savings bank account, current accounts, etc. are called demand deposits. Term deposits are fixed deposits, etc. But there are certain deposit accepting NBFCs. So therefore, these are the two main items of differentiation. And from an investor's point of view, also you need to see that if a depositor has invested money in a bank, then it is guaranteed to the extent of 5 lakh rupees under the DICGC scheme. However, deposits kept with NBFCs do not have this benefit of the insurance. Then, is it required for all NBFCs to get registered with RBI? My view is that yes, all NBFCs who are carrying out either loan giving or advancing loans to its customers, or investing into shares, mutual funds, securities, government securities, etc., need to be registered with the RBI if it intends to carry out the business operations of financing activities. However, there are certain specific type of companies that are involved in specific nature of businesses, and their businesses are unique. Say, for example, mutual funds, venture capitalist funds, brokers who are registered with stock exchanges, housing finance companies, merchant bankers, insurance companies, etc. For these particular thing, RBI does not, these type of companies do not require, though HFC, housing finance companies, are also considered as NBFC, but there are specific regulations. So for all these companies which I have mentioned, they have a special exemption. They do not require registration under the RBI Act because they have other regulations or other regulators who are regulating their work. So therefore, there is a specific exemption for this. Otherwise, other than these, all NBFCs need to be registered with the Reserve Bank of India, who intend to carry out NBFC activities. Second thing, there is also an NBFC, which is a core investment company, where, I have, in the later on in my presentation, I've explained what core investment banking, core investment companies are there. What is, so therefore, if there is a core investment company which intends only to hold shares of group companies, say for example, now Bajaj Holding is there. Bajaj Holding is holding shares of Bajaj Finance, Bajaj Finserv, Bajaj Insurance, mutual funds, etc. So it is a core investment company. if such an investment company has got asset size less than 100 crores, so I'm not talking about Bajaj definitely would be more than 100 crores, then it require, and if it is not accepting public deposit, then it does not require to be registered with RBI. So therefore, core investment companies of less than 100 crores are not required. Only larger ones accepting public deposits are required to get themselves registered. Now, since you are dealing with money, you are giving loans, you are accepting deposits, you're making investment, you are, active player in the financial services or in the financial services sector, then you need to have your strength of your own. So therefore, there is a requirement of your the net worth that you require. So RBI does not allow registration below threshold of the net worth. So therefore, the concept here is on the net owned funds, NOF, which is there. So therefore, currently, the table depicts that the different type of NBFC, the different type of minimum threshold of net owned funds or net worth is there. And there is new regulation that has been come in place since 22 and since 23, the scale-based regulation. So therefore, the scale-based regulation requires the net worth to be upscaled till March 27 to reach 10 crores for all type of NBFCs. So therefore, currently for March 25, the limit is 5 lakhs in case of the normal investment and credit companies, 7 crores for MFI, that is the microfinance, and for factoring companies, it is 7 crores, which is going to go up to 10 crores. They all will have to bring up the net worth funds to 10 crores by 2027. So that's the net worth criteria. Then, as this slide depicts, that RBI has become very strict, and we've been every day reading on some action or the other by RBI. So besides levying monetary policies or monetary penalties, RBI also goes to the extreme step of, if it finds any, serious violations by the management or by the NBFC. For example, recently we also saw action on Paytm. We also saw action on certain NBFCs who were, lending money against gold, who were lending money for IPOs, etc., who are not qualifying KYC norms, data sharing, etc. So many reasons were there. Some penal actions were taken. But in extreme situations, RBI also has the right to cancel the certificate of registration, leaving the NBFC, prohibiting it from any accepting any, any deposits or, carrying out its business activity. So therefore, if you see the table, you also see that every year on year, the number of cancellation of licenses are more than the registration. So spike in 2018-19, but also if you see till recently, till 22-23, the number of cancellations were more than the number of fresh certificates issued. Then also sometimes the question arises that whether FDI is allowed in NBFC. So here the answer is yes. If for permitted activities, automatic route is allowed. So therefore, an NBFC can have 100% holding, foreign holding for specific permissible activities. So even in our case, we have cases where a primary dealer is there, or a loan giving NBFC and infrastructure finance companies, etc., have got 100% foreign holding as far as that is concerned. And here also, the requirement is that if a company also is allowed to have under FDI, if it is into some other company, is some other business and not in the NBFC space, and it's wanting to diversify into NBFC, then subsequently it would have to ensure compliance with the minimum capital requirements and other regulations as applicable even under the both FDI and under this regulations. So now, what are the different types of NBFCs right now under the regulation that we have? So therefore, all these different type of NBFCs will be covered in detail. But first and foremost, under the full non-banking financial institution. So this is, the full framework other than banks in the financial services. So if you leave aside the private bank, the public sector bank, the cooperative banks, the urban banks, etc. So other than banks, there are these all India financial institutions. And at present, there are 5 All India financial institutions which are governed by specific act of the Parliament. So you have NABARD, SIDBI, Exim Bank, National Housing Bank, and the NAPFID, which is the National Bank for Financing of Infrastructure Development. So that's the recent one which the new Parliament had come out. So therefore, these are the all India domestic financial institutions. So these are not considered as NBFC, but they are part of the non-banking financial institution. Then you have your normal banking, non-banking financial companies, NBFCs. So in the bracket figures also indicate the number of companies which are registered with the RBI. So you have deposit taking and non-deposit taking NBFCs. Under that, you also have asset reconstruction companies wherein they take bad loans from banks and NBFCs and they restructure, rather not restructure, but they are in charge of collection, etc. They restructure it, they make collections and they distribute the surplus which they arise after the asset is sold or restructured, etc. Then you have housing finance companies. And under primary dealers, you have both banking PDs and standalone PDs, wherein there are standalone PDs that is on their own account or they undertake government in primary dealership of government securities, T-bills, etc. So these are the various type of NBFCs which are there. So now when these are the various, activities that can be done by, various types of NBFCs. And on the extreme right, the third column, the third column that you see is for layer. So in the next subsequent slide, we will be discussing the different layers of NBFC which have been, recently stipulated under the scale-based regulation of the Reserve Bank of India. So therefore, I will not would like to not jump the gun to the layer. When we come to that particular slide, we will tell you what the layers are. But if you see, there are the types of NBFCs, investments and credit companies. So therefore, initially there were investment companies, NBFC, then there were credit giving NBFC. So there were 3 categories of NBFCs which came together, and now it is called NBFC under ICC category, which is investment and credit companies. So therefore, either they can make investments and hold securities, or they can give credit or give loans to customers. So those are one type of activity. Then there are infrastructure finance companies. So they are basically predominantly into infrastructure loans only. Then core investment companies, what I told you, core investment companies were companies wherein they hold securities, either equity, preference, etc., in group companies only. And the example that I gave you was for Bajaj Holdings. Then you have Pilani Investments for some Aditya Birla Group companies, etc. And there are many for Tata Group companies, Tata Investment, etc. Then you have infrastructure debt funding. Then you have microfinance companies. So therefore, microfinance also are very, important, predominant, and they are most integral part of the government's financial inclusion program, where banks are not able to reach geographically. Microfinance, local microfinance reach loans, villagers, household, that. So therefore, that is microfinance loan. And there are certain restrictions on microfinance company on the loan ticket size, etc. Then there are factoring companies where they get into trade finance, etc. Then there are non-operating finance holding companies. So this is typically when some promoter or some group wants to form a particular bank, setting up a bank, and then it has to come through this non-operating. So the function of this company is only to hold shares of that particular bank. Otherwise, no other operations are allowed. So the clear example of this, but now this particular forms have been relaxed. And now the RBI, is not, it's no more stringent about this law. So therefore, you see a lot of mergers of non-operating financial holding companies with operating banks as such. So last we saw the merger of IDFC Bank. Then that has been announced. Then earlier Equitas and Equitas Holdings also a merger happened. Ujjivan and Ujjivan Bank also structure has happened. So therefore, these are those. Then there are mortgage guarantee companies. They undertake only guarantees as far as mortgage loans are concerned. Then there are account aggregators as NBFC. Account aggregators are again interesting new field. This is also where professional opportunities are available, where these are particularly new age businesses where they are not particularly in the business of giving loans, but they are into collecting data, information from financial assets and collating it and giving in a structured way to banks, NBFC for some specific use with the permission of the customer. Then peer-to-peer lending platforms are there. So therefore they prefer, provide an online platform where peer-to-peer lending can happen. And housing finance companies only as far as giving loans for purchase of residential property, for dwelling units, purchase, construction, renovation, etc. of these activities. So therefore, now coming back, coming to the strict regulation of the NBFC, naturally RBI is the regulator for NBFC, and RBI regulates NBFCs. And though banks are more stricter, they have a more transparent process, they have a more robust system of controls, etc. RBI is more hands-on with the banks, but the importance of NBFCs for a growth of a country cannot be, is not demeaned or is not left. So therefore, it also needs to be encouraged. The NBFC sector also needs to be encouraged. Though a couple of frauds, a couple of management failures in NBFC have happened, the growth is not has not significantly impacted the growth of the NBFC sector. And as I told you, financial inclusion is one particular point where NBFCs being more smaller and more regional based, more geographically situated, strategically situated, it could reach say for example some Bandhan Bank, etc., which was a microfinance, etc. It went into the northeast region, the east regions, and could give loans to small people for farming loan, personal loans, housing loan, etc. of small tickets. So therefore, NBFCs become important for financial inclusion point of view. RBI wants to regulate NBFCs as they do for banks, and we've seen this moving forward, and more stricter regulations which are coming. The new regulations which are coming are keen to a bank, and the message is very clear from the regulator that yes, our NBFCs are important. You all can operate, but you all will have to operate within this discipline, within this framework which is described. So therefore, that's the message very clear from the regulator. So as I told you, briefly, I was discussed what is the type of NBFCs which are there. So I would not like to repeat, but these are the more type of the NBFCs which are there. And the most important, NBFC is also the merger of the asset financing companies or investment companies, lending companies into a new category called investment credit, infrastructure finance, debt, etc. In the previous slide have been covered. So I would not. So therefore, there are certain amount of NBFCs which are more particularly only into particular activity. For example, loan giving loans, gold loans, etc. So that we will be covering moving forward. Also, NBFC account aggregators, etc. are covered. So therefore, these are the certain recent regulations which have come, which are impacting the performance of or whether they direct have an impact on the performance of NBFC. So this is just, I've just gone back till I think so 22, 23, where we have giving certain important regulations which came. So the first one was on implementation of the core financial service solutions. So therefore, it is important on the automation, how in the bank, the RBI or the regulator has core banking system. In February 22, the regulation for having a centralized service solution for NBFC was introduced. Then along with that, also it has introduced into automation, how do you classify assets, etc. That has come. Then in April, there was certain regulations on, directly linked to the NBFC functioning was compliance functions and the role of, there was, importance on having a chief compliance officer, etc., to have a policy around it, to have defined functions and role of the compliance officer for NBFCs. So far, chief compliance officer was there only for banks. So such a function has been there for NBFCs also. So therefore, there is one such option also. So what we will be discussing today is, of course, I'm not going to discuss the opportunities in the industry itself as far as jobs are concerned, but outside the job market in the NBFCs, which we'll be discussing. Then there was this large exposure framework as far as banks are concerned, restriction on giving loans to a single NBFC or single group of not more than 10% to the NBFC single group. So that restriction was there. Then guidelines for compensation of KMPs and senior management also were there, because you can't just go and like banks, it is very regulated. The banks have to approach the RBI for approval for payments to its key management persons, the MD, the EDs, etc. So therefore, these fresh guidelines were there. Then there were these loans and advances regulatory restrictions for NBFCs, that on where there were restrictions on giving loans, sectors where the banks found that there was regulatory or systematic stress. So therefore, there was that restrictions were put as far as NBFCs were concerned. Then for upper layer of NBFCs, there is capital requirement. So there, the message again is very clear. And in one of the close speeches where I had attended a program where there was a lot of UN cry a couple of months ago against the systematic growth in the unsecured loan portfolio. For example, credit card loans, etc., personal loans which are not backed by any security. There were these loan stress. At that time, the RBI governor, the tone was very clear from the top that, okay, this is your business model, you give your loan, but you ensure that we have adequate capital to cover all the losses or potential losses or the risk that is coming. So you should be adequately capital covered. So therefore, capital adequacy were there as far as banks are concerned. Now it is more stricter for NBFCs also, upper layer NBFCs also have been covered. Then provisioning on standard assets akin to the provisions for the loans that we loans from banks that we have. So that is at par. Most important, and we made 3-4 slides on the scale-based regulations which has come, which were issued. I think so. The draft were issued in 22. And from October 23 is there, and October, November it got updated, and there is a fresh master direction. So therefore, what I have a couple of slides for the scale-based regulation. So we will be covering that. Then in November 23 and in December 23, more stricter regulation came towards more risk weight to be assigned to consumer credit. That is what we were talking about, loans to NBFCs for banks perspective, and loans to credit card also again from bank perspective, because NBFCs are not just now allowed to have credit card. It can have co-branded cards, but not on its own. And then consumer retail personal loans, any loans backed without any security at the discretion of the credit of the consumer, and no end use is asked for the loan. So today, you just convert your a big purchase on your credit card to EMI. Those type of loans were covered. Then also to prevent misuse of AIF funds, there was round tripping or evergreening, which in 1 or 2 cases where Reserve Bank of India has punished everyone. So therefore, this AIF has become a big topic of debate, and representations from the industry say that if the regulations go the way they are, then the AIF itself, the full industry may die down, may die a natural death, etc. So now coming to scale-based regulation, there was a revolutionary change as far as the regulation framework from RBI towards NBFC was there. So therefore, in public interest, and the main preamble for this framework was, to enable the Reserve Bank of India to regulate the financial system to the advantage of the economy or the advantage of the country, and to prevent any misuse or any affairs of the NBFC to be run in an affair so that it could jeopardize the interest of the depositors or the interest of the investors or the investors, etc. So therefore, this scale-based regulation was formed, and this is a full direction of about 350 odd pages, which supersedes all other master directions on these, and it has in one consolidated master direction are there on scale-based regulation. So for simplicity's sake, we will call it SBR regulation, and SBR classifies the SBR, the scale-based regulation, classifies every NBFC into 4 layers. The 4 layers are the base layer, the middle layer, the upper layer, and the top layer. It classifies into that. And the classification is either based on the size of your NBFC and based on the activity that you carried out and based on the perceived risk that what could go wrong in that particular activity or that particular model or that particular offering that you are offering. So based on these 3 or 4 broad criteria, the classification of NBFCs that happened in the base layer, middle layer, the top layer, upper layer and the top layer. So therefore, which NBFCs are classified or always will remain under the base layer. Non-deposit taking, earlier they were depositing and non-depositing. So therefore, any NBFC which is not accepting any deposits and its size, asset size remains below 1,000 crores will remain in the base layer. And particular activity wise, if there is an NBFC that is irrespective of the size, this is if there is an NBFC undertaking the following activities, that is peer-to-peer lending platform that we explained to you, account aggregator, because this is basically not into lending money, but they are providing allied services to that. Then non-operating financial holding, which I had described to you in detail, and non-banking finance company not availing public deposits and not having any customer interface. So you're not dealing with customers. These type of NBFCs will always remain in the base layer. In the middle layer, so this is the big layer. In the middle layer, chunk of the NBFCs are falling into this. All deposit-taking NBFCs, irrespective of the size, will fall into the middle layer. Then all deposit-taking NBFCs with asset, non-deposit-taking NBFCs with asset size of more than 1,000 crores and above will fall into the middle layer. And NBFCs undertaking the following activities, that is, as I told you, either they are into infrastructure, debt financing, or core investment activities, housing finance companies, irrespective of the size they are, they will fall under this so-called less than 100 crores for CIC will not this thing. So then the housing finance companies, non-banking infrastructure finance companies always fall in the middle layer of NBFC. And then as far as upper layer is concerned, at that time, in 22, when these regulations were there, they had, RBI had come out with a specific upper layer list. So therefore, specifically, they had set out parameters and the scoring methodology which is provided in the master direction. And the top 10 eligible NBFCs will always be in the upper layer. And these have to be monitored very strictly in that. So irrespective of what other factors, if they qualify under the scoring methodology as prevented, then these will remain unchanged. This will remain in the upper layer of NBFC. And right now, there are no NBFCs in the top layer, and the intention is to keep it blank only unless and until there is some systematic risk or the Reserve Bank of India feels that any such companies would be required to be coming under top layer, which will move from the upper layer only. So therefore, this is a description of what we had told. This is just a repetition of what I had covered earlier. So this is just, I can skip and move forward. So therefore, what are the restrictions? So therefore, we have this base layer, middle layer, and upper layer, the 3 columns. And what are the requirement of the SBR framework? I've been listed out. First and foremost thing on the NOF, that is the net owned funds or the net worth criteria. So therefore, this also again we've been discussed earlier. Right now, there are requirement is whatever the requirement is of 3 crores, 5 crores, 7 crores, etc. But by 25, it has to move to 5 and 7. And by 27, they'll have to comply. All these NBFCs will have to comply with the 10 crore criteria for the net owned funds or net worth. Then KMP, management personnel like you have, there will be, just now for base layer, there is not required because systematically risk is less as per the RBI risk assessment. But however, the middle layer and upper layer, there are restrictions where the KMPs can hold offices in other NBFCs of the middle and upper layer, etc. So therefore, you cannot have one person in multiple NBFCs, etc. So therefore, that restriction is there. Then for NPA classification, the requirement for harmonization is there. And now I think so more or less from the next year moving forward, of course, for base layer, yet you have the criteria for from 180 days to 90 days overdue by March 26. But however, I think so more or less for other NBFC, the 90-day criteria has already been set in place and 90-day criteria uniform is there. Then, as I told you, for CET, minimum, common equity tier one capital, which is requirement. So that is not applicable as far as base and middle layer is there, but for upper layer, there is a mandatory requirement. Then appointment of chief compliance officer, mandatory both for middle and upper layer. And then for core banking solution, again, mandatory for the middle layer and upper layer and not mandatory for the base level. And as far as listing is concerned, because more transparency, etc., come out, the upper layer NBFCs who are required to be listed by 27 or 26 or 27 by the 3 years from where the restrictions would apply. So therefore, you see a lot of churn already happening in the industry right now. So there was this, I think so, L&T Finance Holding, which merged, 2 or 3 of its group companies. The same thing happened with, I think so, Piramal Enterprise is planning to merge with Piramal Housing Finance, Tata Finance Services is planning to merge with Tata Capital Services, etc. L&T, it's happening. So therefore, also, it's happening with L&T Finance, Aditya Birla Finance and Aditya Birla Capital. Also, recently we've been reading that Tata Sons and the two holding companies are looking for exemption as far as listing is concerned, but how far they will be successful, only time can say. Then again, the requirement of the scale-based regulation, capital requirement already been discussed, the leverage ratio, the capital adequacy, net owned funds, then governance structures for the risk management committee to be there, then experience and qualification for board members, the core banking solution, KMPs, etc., compensation package, all that governance standards are there. Then prudential regulations as far as NBA classification on a real-time basis is concerned. So it has to be the regulation which has come out that initially many NBFCs were doing or were recognizing or running the NPA patch at either end of the month or that particular. So now all NBFCs are required to on a real-time basis as a part of the day-end process to recognize NPA classification based on outstanding or overdue. Then concentration of credit and investments requirement of prudential regulations are there. Sensitive sector exposure needs to be disclosed or needs to be identified. Sensitive sector would mean either a real estate, commercial real estate exposure, capital market, etc., etc. Regulatory restrictions on loans to directors, relatives, senior equity, senior officers, etc. Large exposure framework was what was discussed with you. Internal exposure limits also are there. So that was particular as far as prudential regulations are concerned. And then the next one is on the internal capital adequacy assessment process. So this is ICAP, which is already existing in banks, is required to be there for NBFCs also. So therefore, we have a couple of slides on that. What exactly is the the full process or the full document around ICAP is there. So therefore, this area, my friends, would also be another important area where if any practical experience and you have, and if you have read, this is the big area where the larger firms are practicing and they are helping NBFCs create a document, create a policy, create compliance as far as ICAP is there. So therefore, this particular would include would be another professional opportunity in this sector. Then I think so. There is another slide on the disclosure requirement. There are more stringent disclosure requirements as far as NBFCs are concerned. The new disclosure requirement, only one that I would like to point over here, is on the divergence. So whenever there is actual divergence in the classification or the provisioning as per the management, and if there is a difference with that classification and identification and adequacy of provision as identified by the bank or the management, and when the RBI inspection happens, and if they find out there is some divergence in these, then beyond a threshold limit, you need to disclose these divergence. This requirement, friends, was always there for the banks, but was not there for the NBFCs. So therefore, for the upper layer, this particular requirement has come. Listing obligations was also discussed with you, that what are the requirement for listing of the various category, and other such strict regulations, etc. are there. So the focus of the scale-based regulation has shifted from activity-based to perceived risk of the operations, and what what could go wrong. It is based on that. Then government-owned NBFCs, there is one particular challenge that the government-owned, though, there is another slide which shows that the government-owned NBFCs, almost constitute 43 to 47% of the exposure of the NBFC sector. They are, exempted from the categorizing. So large NBFCs like REC, FCA, Power Finance, etc., would be out. Okay, here it's mentioned that about 46% is, as far as on June, so which has become 43 or 47% by 23 figure. So they would be out. So that whether, not RBI felt that need to be out. Then implementation will always be stringent. The accountability, transparency, and the trust will go up. And also from the NBFC perspective, the regulators' intervention has become very strict. In banks, we used to have, there is a SSM that is in charge of the bank, who has a supervisory officer who does, is assigned to a particular bank, and he is responsible for the compliance, and he's, a one-point contact between RBI and the bank. Similarly, there are SSM appointed for NBFC. They do the annual inspection, and also SSMs have started calling auditors of NBFC for regular interaction and regular monitoring, and to know what is happening, if there is any systematic risk, etc. Or no. So whatever, right now, industry people are feeling that whatever the arbitrage or whatever was available with NBFCs, or what flexibility was available with NBFC and was not there with banks, is now dwindling, and there is no particular, arbitrage which is there. So once, these all regulations come in force, there will be, more transparency, more trust as far as this sector is concerned. And I think so that will work in the benefit of the, people in the industry, people working for NBFC, people, investors, depositors, etc. So these are just the, disclosure requirements which were there. For base level, there are maximum, relaxation which were available. For the upper layer, there are no, relaxation as far as disclosure requirements are there. So unhedged foreign currency, corporate governance, etc., all becomes applicable. And I think so for middle layer and upper layer, most of the disclosures are required, are applicable. Then this was the overview which I was saying, if you can see here, and all this is from RBI published information only. So therefore here what you can see is that the ownership pattern of NBFC. So mainly here you can see as far as deposit taking, non-deposit taking NBFCs are there, it is more or less equally 43% by government companies, 57, but for 43% is held with private companies also out of the 57. But as far as deposit taking, if you see, majority of them are in public sector, public limited companies, 88% and 11% from the government companies. So therefore their comfort is there that, the private limited companies where the transparency or the corporate governance level could be at doubt, or could be less transparency as far as their in deposit taking, their their presence is near to negligible. This point also again, was discussed earlier, that there is a systematic risk as far as secured and unsecured portfolio or loans given by NBFCs is concerned. So if you see from 20 to 23, there has been a constant drop. If you see the green on the left-hand side, which said that more than 75% of the total loan share was in secured, which has gone down to less than 70% in 23. And if you see the growth on less than 25% has gone to more than 30% as far as unsecured, because naturally unsecured lending comes with its own risk, though it comes at a higher return, but it comes with its own systematic risk. And more heartening to see is that the growth for 23 has been 11% as far as secured is concerned, but more than double. It is almost like 30%, 28% growth in the unsecured portfolio. So this is where the government is, this is where the RBI is coming from, and they have taken a lot of steps to discourage this undue unsecured lending by NBFC, which creates a systematic risk in the system. But hopefully this has been on the radar. And so far, our experience and what we have been reading and what we have seen with our clients, it does not seem that this is going to, skyrocket. But as of now, if something goes wrong, geographical, political tension, again, a COVID type situation where job levels, job losses are there, a little slowdown in the industry, salary levels drop, etc., jobless increases, then these unsecured loans could be at a systematic risk. Then also, the total assets, if you see what has been the growth rate. So if you go to see, yes, there has been superlative growth rate as far as NBFCs is concerned, which has crossed, 30% growth. Though the portfolio is very small, if you see the MFI portfolio would be less than 3% of the total advances given, but the growth has been 30% on a smaller base. And if you see majority of the growth of the market share of more than 61 to 62%, which is growth, is for the investment and the loan giving, and followed by infrastructure financing, sheer by the nature of loans, because these are big and large loans. However, the growth also has been handsome. It's moved from 7 to 11% as far as infrastructure financing is concerned. Then this is a more peculiar that how the full, the global NBFC sector looks like. What is the size of the full NBFC sector? So here, as per the registration details, as per the returns of the Reserve Bank of India, if you see the column number 8, which is the total of 9 and 10, the total assets of the NBFC sector is approximately 47 lakh crores, out of which majority, about 37 lakh crores, out of which is for loans and advances. Investment for a small portfolio of less than 6 crores, and other cash and bank balances and other assets which is there. So therefore, this is the main composition of the advances and of the liabilities. Naturally, it would be the share the capital remains it's fallen from 23 to 24, from 11 lakh crore to about 10 lakh crore. But though it's more than what was there for 22, so therefore that is there. And the more loan borrowings, borrowings from bank, if you see, as more or less remains, little slight growth is there. 25% growth from 11.33 crores to 11.97 crores. So therefore, that particular growth as far as the banking loan. So that's another systematic risk which the Reserve Bank of India is trying to address, where banks are giving to NBFCs and NBFCs are lending further. So that also becomes a systematic risk. Then this is the compositions of assets and liabilities classified NBFC, the type of NBFC wise. So here this is just fine. Factoring does not make, but main growth has been 10% growth in lending. 19% growth. If you see extreme column number 9, extreme right hand side, 19% growth in loans and advances. That's a healthy sign as far as assets increase is concerned. Then now, what is the distribution of NBFC credit? So, that's just the industry, retail, etc. is there. So, retail also is growing, there's a more than 2% jump from 22 to 23, 28 to 30%. That's the share of the retail loan as far as, the loans are concerned. And yes, industry remains the maximum consumption, but their share has fallen from 38 to 37%. from 22 to 23. Growth rates also remain very, very robust as far as retail loan is concerned. And that also links with the newspaper reports that were recently mentioned, that the percentage of savings, family saving, is coming down because a lot of consumption is happening. People are spending on lifestyle, etc. And of course, though the culture has not yet moved to the West, where you live, you borrow and live. So therefore, that particular culture is not there, but that creates a systematic risk. And again, Reserve Bank of India is looking at that. Then sectorial distribution, if you see MFI, also majority of them are into retail loans. MFI, 95 to 90% of the MFI loans. And again, main thing is on industry again. And if you see the ICC, the retail is there. Again, there the retail is 48, 49%, and retail has got more loans given to service in the service sector, industry, agriculture, etc. So this is particular sectorial breakdown. Then, if you see again why it's important that NBFCs survive along with banks. If you see here on the extreme left-hand side, funding to MSME, where MSME is where the growth potential is there. The government also is putting a thrust on MSME. Who has funded the MSME? If you see 21% growth funding to by NBFCs to MSME was 21% in 22, which has grown to 42%. So therefore, that growth is there. So therefore, NBFCs are funding MSMEs. Again, MSMEs come in with a little bit of higher risk than the industry. But this is, the story behind, the success of NBFCs, that why NBFCs have been able to sustain the growth rates. Then what are the major components or major products where the NBFC is growing? Yes, it is, 3-4 areas. Personal loans definitely is there, but also vehicle loans. If you see, there's a sudden spike from a negative growth rate to positive, more than 20% growth rate as far as vehicles are concerned. And the gold loan also is at a healthy, growth rate, which is again worrying as far as RBI is concerned, because gold loan again comes with its own problems, comes with it again risk of fraud, defaulting, wrong gold, of wrong measurement, or connivance of the valuer, etc. So it comes with its own set of problems. Microfinance again has been good. If you see, the growth has been 37% as far as microfinance is concerned, compared to 24% growth which was there as far as outstanding microfinance credit is there. Again, more from though the bank share of microfinance has come down from 40 to 34%, and that of NBFCs, that is the microfinance, have gone up from 35 to 39%. That's the story behind microfinance loan. Sectorial credit, that the loan has been given to whom, so that was that total of total gross advances given under which category. So I'm just leaving. I don't want to say much on this, but I'm just leaving this. That what has been the major movement, in which areas there has been major movement, that can be kept. Then this is the picture of how the systematic banks are lending to NBFCs. So again, here the overall exposure, though the exposure has fallen possibly from 9 to less than 9% growth rate, but yet it is growing. So who's lending to the NBFC sector? If you see, public sector banks are, over the period of last few years have, given majority. But if you see private sector bank, from 26%, they are, 29% share it has gone. And for public sector, it has remained more or less 68% to 65%. So there's that shift as far as loans to NBFC is concerned. And in what way? It is mostly by way of direct lending only, and not very few as commercial paper or debentures, etc. So that has been the main sourcing of. I'll just take a break for 1 minute. Yeah. So coming back to the profitability of the NBFC, if you see, the profitability ratios also show over there that how NBFCs have been profitable, and year on year the profits have gone up constantly. Financial parameters, income growth, if you see, again, in 23-24 first half, overall growth of, in the range of 15 to 23% as far as NBFCs is concerned. And expenditure net profit growth also has been healthy, as about 30% for both NBFCs and systematically important non-deposit taking NBFC. And if you see more of the ratios also, ratios are pretty much strong over the years. Asset quality, always improvement. If you see the provision coverage ratio stands for, suppose if you have a 100 rupee loan and you have 70 rupees provisioning against that, so then it would mean a 70% provision coverage ratio. Provision coverage ratio also, if you see in the green on the left hand side top, from 60% has moved to 65%. So there has been an overall growth in the provision coverage ratio, because we all have been reading that, at least as far as banks are concerned, in the previous 2 or 3 years, the quality of assets have gone up, because what all cleaning was required, or whatever cleaning was required in the banking and the in the industry has happened. All bank loans have been written off, large industry loan, retail loans are the ones that are getting added. So therefore, this has been a very bright period as far as banks and NBFCs are concerned. So therefore, they are creating hidden reserves, that they are trying to making hay while the sun is shining. So therefore, they are trying to create adequate buffers, that even though there is a downturn or the cycle overturns, then they have adequate requirement with them. So therefore, more since the asset quality is good, the provision requirement is less. So therefore, provision coverage ratio is moving forward, and this is a good heartening sign as far as the industry is concerned. And let's hope that this goodness continues, because a lot of industry experts are saying that this is too good to be believe that this will remain like this forever. But so far, there's no mishap, so we are comfortable as far as that is concerned. As far as capital requirement is concerned, most of the types of NBFCs are comfortably over and above the statutory requirement of 15% capital adequacy, which is the stipulated norm, and more or less are above. So therefore, there is enough capital to expand their business or to absorb any losses which are there. Now, coming to the professional opportunities which are available in this particular sector. So yes, since I am a statutory auditor, first I would sell my service line only. In 2021, RBI changed the guidelines of appointment of statutory auditors as far as regulated entity is concerned. And there were these new concepts which came up as far as, mandatory joint audit for all, NBFCs or regulated entities having more than 15,000 crore asset size. Then there was compulsory rotation. Then, so therefore this concept of rotation after a gap of 3 years, appointment only for 3 years, and then cooling off period for 6 years, and then being eligible for reappointment. This has opened ample opportunity for firms who are well known, who are doing good business, who have got good infrastructure and presence across various locations, and have these requirements of CISA, DISA qualified partners, number of partners, number of experience, etc., are being given audits of larger institutions, larger banks, and larger NBFCs. Also, there has been one positive development is that there is a restriction of 8 NBFCs that one firm can take. So therefore, larger firms who were doing more than 8 NBFCs, now they have restrictions. So therefore, these NBFCs have opened for other firms to take. And therefore, there is this big opportunity which is available as far as statutory audit is concerned. So in statutory audit itself, though being listed banks would be covered for NFRA, but though these regulatory risks as far as compliance and your documentation, your quality of audit, etc., hangs. But also it's a big opportunity for statutory auditors to open up, that the sector has opened up and they need to, make inroads if already they have not made inroads. And we know of many firms who have really progressed in the last 3 years because of this particular change in guidelines for appointment of statutory auditor. So along with statutory auditor, the responsibility also would be on reporting on internal financial controls over financial reporting and CARO. As far as NBFCs are concerned, CARO reporting also becomes applicable, and all the of course, though there are some relaxation as far as some clauses on loans giving are there for NBFC, but the other clauses on maybe fraud, round tripping, or etc. going concern might cause some, might cause some challenge as far as reporting is concerned. Then the full traditional model of audit has changed from sample selection, materiality. Now the audit has gone on big data. The audit has gone on 100% since technology is used. So therefore, the full audit has been based on, you can't have now sample size on, the full data you are doing your audit. You are running queries, you are running programs and etc. And, getting exceptional reports and doing your audit. So therefore, that particular thing has changed. Of course, when you do audit for NBFCs, statutory audit for NBFCs, you and your team have to be kept updated with all the regulatory changes, all the regulatory requirements, and expectations of the regulator, etc. That also needs to be there. And this year, the challenge would be on the audit log or the audit trail, which requires to be maintained as required by the Companies Act. So therefore, all NBFCs being companies would be covered under this. And this also not only in statutory audit that requires or throws up challenges in not only first identifying which accounting software qualifies to be, which software qualifies to be an accounting software, and the requirement for audit trail or audit log is there. And plus, not only that, but how do you ensure that it is there? How do you ensure that, it's not tampered? And how do you make sure it's a very technical thing, So therefore, as a statutory auditor, plus from a professional side, if any firm has got an IT team or has an IT expert or understands how the databases, how the software works, etc., then it becomes an opportunity for that firm to get involved with the IT implementation, to involve NBFCs, because yes, larger NBFCs would be able to spend money, get work done, but for smaller NBFCs, they might not be having in-house capabilities. Though many of the NBFCs might be having chief technology officer, etc., but it would be difficult, to get that. So therefore, that would be again a low-hanging fruit, and equal opportunity as far as that is concerned. So this is as far as statutory audit is concerned, and through the risk and reward, the fees also would be commensurate. But yes, you have to do a proper due diligence, KYC of the NBFC that you are planning to, the background of the promoters, the business model, what they are covering, what is the technology, what is the finance team, how is it looked, etc. Because if it's non-listed, it becomes all the more important. If it is listed, then they are more strictly regulated. Quarterly limited review happens, more reporting to stock exchanges. They would be paying adequate for professionals to get the professional services done, etc. So for unlisted, that risk little increases, but do a proper due diligence, and I think so. Now the fee levels also have gone up, so therefore this could be a very good opportunity as far as statutory audit is concerned, as far as NBFC. And remember that once appointment happens, yes, there is no requirement to take a prior approval from Reserve Bank of India, but once appointed, then you have to inform the Reserve Bank of India about the statutory auditor. And as per these regulations, there are various requirements, of the size of the partnership firm, etc. Eligibility criteria to be appointed as statutory auditors as per the guidelines of the appointment for April 21 is concerned. Next, and the most best opportunity again is with concurrent audit, is with internal audit. I don't just now mix it up with concurrent audit, though it's an important function, and the bank, the NBFCs are required to have an internal audit department, but they can co-source or outsource part of the activities as far as internal audit is concerned. And again, here the risk is involved. And now for good governed NBFCs are having meaningful internal audit reports, internal audit done, and their coverage also is adequate, and the fees remuneration also is adequate in commensurate, because gone are those days where just they wanted a tick in the box, and for caro purposes they wanted an internal audit done and there was no report, no formal presentation. But again, there is a regulatory role for internal audit, and the RBI also is more stringent, because this internal audit becomes the third line of defense, and before which things can go wrong. The internal audit has a good pivotal role to be played. It has responsibility as far as the governance structure is concerned. And though there is a requirement for certain type of companies to have a compulsory internal audit function in that way. So therefore, that can come. So therefore, as I told you, a lot of banks and NBFCs are doing, co-sourcing. So they are taking these external firms to co-source some part of their internal audit functions. As far as that is concerned. Also, sometimes review of related parties, etc., are also done. The arm's length pricing is also done by internal auditors, etc. And again, IT function also it plays an important role as far as that is concerned. Consulting, again, there's again, one thing to be kept in mind is yes, it's very clear that the same firm cannot do internal and statutory audit. But as far as consulting income also is concerned, the RBI regulations is very clear. According to them, under Section 144 of the Companies Act, whatever falls into that consulting services or whatever falls into that other services as far as Section 144 is concerned, you need to see that there is no independence issue, there is no conflict issue. You cannot be doing your own work and reviewing it. Self-review threat should not be there. So therefore, RBI is very clear that if you have done any consulting services within 1 year of your appointment, you become ineligible to be appointed as statutory auditors of that particular regulated entity. Also, you need to see on the network, though these networks are only for larger firms, but they use the common ID, the common address, the common code, what do you say, the common branding, etc. The cards are common. So therefore, there might be two different firms with two different partners, but the branding would be same, the email address would be same. So therefore, those are considered as network firms. So therefore, you need to be kept in mind. As far as consulting is concerned, there is a huge opportunity if you are not looking at the statutory audit of that particular, because what would happen is that as a consultant, you become part of the management itself, and you can see a lot of things from the internal side that what is happening, and therefore that requires. So therefore, consulting can be of many. You can have their policies in place, you can have the governance structure, etc. Fundraising, etc. Many such type of consulting assignments can come through your way. Then another important is also outsourcing, though it is called, maybe you might, some people might consider that it is very low value and does not add value, but it's a huge opportunity which is there on co-sourcing or outsourcing services. Though the RBI, unlike other companies, there is no restrictions on outsourcing, but for RBI, there are restrictions on outsourcing, and they are not allowed, on the, to outsource the preliminary function or the core strategic functions. Compliance functions are not allowed, but however, outsourcing opportunities are available in payroll, in secretarial compliances, in other compliances, filing of TDS returns, filing of various returns that are required for guidelines, because the number of returns that RBI requires have gone up. So therefore, their professional services, there is a scope where it can be rendered, where it can be done by a professional service, accounting services, etc., can be done by an outsourced agency. So therefore, that can be done. It becomes another opportunity. Then again, CSR applicable. So again, full gambit along CSR becomes applicable. So therefore, if your firm is experienced or has the profile or has the experience of implementing CSR, on advising of CSR. That can be done in the full, policy around CSR, the full having a committee for the CSR, how the funds are spent, how they are utilized, impact analysis, the reporting, etc. If CSR money is not spent, what to do, etc., across everything, So that becomes another important area as far as that is concerned. Along with CSR, also ESG comes, I think so, that also has been covered somewhere as far as that is concerned. Then again, as I told you, audit trail has become important. So this falls in place along with the IT requirement. So once the IT, if you are getting into consulting of IT and you have a team that is specializing, and I know of some firms, larger firms, who have engineers and, non-chartered accountants in their IT team, and they do these very technical work, wherein because this audit trail, what are the, maybe yes, there could be a combination between the stat audit or the audit team, chartered accountant function who understands the accounting software, and the technical team, because technical team will be required to identify that at the database level or underneath what changes are happening, whether, the edit log is there, whether it has been tampered with, who has looked into it, etc. So that would become technical. But again, this is another area where you can render services, and along with this, there is another lot of other fields which are there on IT related matters, which are required. Then the requirement is again some specific assignments which can come through. Say, for example, right now we heard that in some NBFCs, there is a forensic audit, or there is another re-audit, or, special audit that has been, given to a large firm. But smaller firms were used as far as gold loan verification was concerned, because RBI thought that this was a systematic risk. So it identified a couple of NBFCs who were giving loan and gave this assignments to some firms of chartered accountants to shortlist, to visit certain branches, and on surprise level, or go and identify the gold loan, verify the loan, weigh the loan, and see whether it's the same purity, and whether any non-compliance as far as that is there, whether there is any fraud as far as the loan is, the gold is concerned, physical presence of physical loan, etc. That was required to be checked, and that's another opportunity which was there. So again, here that I spoke about is on the ESG, because ESG itself would become applicable. So therefore, the not only on the advisory of ESG, but also on the assurance part of the BRSR reporting that would be required, certification, and the preparation of the full document, the policy regarding the ESG compliance, etc. RBI also has allowed bank and NBFC to accept green deposits. So maybe if you have a experience around that and read that, then you can help in implementing an advisory review of these green deposits, utilization, etc. by third party can be done. Then another traction that we are observing is in the gift city operations, where we believe that because of the government thrust, and because of the tax incentive, and because of the the natural benefit that one foresees, nobody wants to miss out from the gift city. So therefore, everybody wants a presence, and everybody is waiting and watching for the potential to be unleashed. And hopefully, this would become a success model to be followed elsewhere also. So therefore, there is a lot of opportunity where right now we believe that some operations of some NBFCs, for example, REC, etc., are setting up separate subsidiaries to to have gift city operations in that FSC zone, in the trade free zone, and from time to time advisory, because there also their advisory would be required on certification, on statutory audit for local authority for the IGAP conversion into the the financial reporting that is followed by the holding company, etc. That would be required. Then IPO service, Ind AS conversion and transition to IPO, etc., and fraud investigation also another areas, another assignment which can be taken. So IPO is we're helping them, holding their hand as far as, validating and certifying the information that was required to be filed with the red hearing prospectus, etc. Then India's conversion, transition into India's, then on the ECL model, etc., on which model to adopt, etc., could be given. Fraud investigation also, there's another scope where independent NBFCs do not want to appoint hi-fi firms, so that, if there is any suspected fraud or any employees connivance or something, they suspect something going wrong, if they appoint some big firm, then, it might go out of proportion. They might get negative publicity. So therefore, a small firm is appointed to carry out these activities. So therefore, there it could be an interesting opportunity. There are also opportunities where, there are suspected misuse or diversions of funds as far as onward lending to borrowers is concerned. So therefore, NBFC could initiate that specific report or reporting on customers which have turned NPAs, etc., or red flag account, etc. So that can be taken. So that can be besides, I think so more or less most of us are tax expert, more or less a GST expert. So though I'm not an expert, so I don't know what other facilities could be there. But yes, more around litigation of income tax, FEMA advisory on compliance, representation to because if you have a good experience on the NBFC sector, financial services, you would know what the typical pain points are as far as the direct and indirect tax concerned is there. And if you have experience, if you have dealt with, then this becomes a service line where you can offer, and your experience can be used. IT, again, as I told you, there's a requirement of identification of NPA on a real-time basis that needs to be done on a daily basis as a part of day-end process. So you could assess that on the other IT functions as far as, disaster recovery, etc., contingent plan, which is there, the full CISA fraud framework, which is required, CSID, cyber security, etc., can be, given also. Health checkups can be done as far as hygiene checks, whether your documentations are in place, whether the valuations are updated or no, whether there is timely updation of the valuations that are got, whether the immobile properties have been valued in within the timelines, review of related parties, transaction, concurrent audit of treasury operation. So these becomes various other service lines can be offered during mergers and acquisition. Valuation can be done, determining share exchange ratio, etc. Due diligence becomes another service area that you could have. Then structuring of transactions, etc., could happen as far as that is concerned. Naturally, FEMA health check, whether you have complied with FDI norms, whether if any other particular FEMA compliance, your ADR, annual performance report, etc., have been filed properly with the Reserve Bank of India. SEBI compliances, etc., becomes again important. Now, finally, I think so. This also again would require specific knowledge on the ICAP requirement. I told you earlier that there is this requirement, so there's a huge opportunity, and other larger firms have already turned up, and we know for sure that 35-40 lakhs are charged for one such assignment, and regularly it becomes once in 2-3 years you need to update this document, this full process, this full committee. So therefore, that requirement would be there around the full process, which is required, whether the internal capital is adequate to assess the full process, if the particular risk of the entity is such, so whether it is holding adequate capital and all the structures around governance around it, so that becomes important. Then another advisory on the last, I think so, concluding slides are that there's been, what are the trends that have been taking place. So therefore, on this consumer credit, there has been a huge UN cry. So recently, I think so, in about November 23, RBI came out with a circular where it had increased by 25% percentage point on RWA to be calculated on certain amount of unsecured portfolio, credit card portfolio, as I earlier discussed, that there was a requirement of carrying additional 25% risk weight So therefore, how do you identify consumer credit in case of some particular loans? So yes, housing loans are not particularly covered, but if you have some top-up loan on the housing loan where the end use is not monitored, whether that would construe as a consumer credit or that would not construe as a consumer credit is a line of debate, and that you need to see that what could form part and whether it is carrying additional risk weight or no. That is there. Then on AIF, as I told you, there was a requirement from RBI that this was to prevent, as I told you, evergreening or this was to prevent, evergreening of loans, wherein you have invested or the NBFC or the regulated entity has invested in an AIF structure or in a fund, and that AIF further downstream has any direct or indirect exposure to the debtor of the NBFC, then therefore this particular thing needed to be unwinded within 30 days of the regulation, or if not unwinded within 30 days, then it used to, 100% provisioning was required. And when this regulation came, we saw one or two big, large NBFCs, which I don't want to name, but it's already there in the public domain, where they carried huge provision as far as this was concerned. And it was shown also as an exceptional item. And then there was some clarification which came out on the equity holding, but that clarification is not yet clear, not yet, it's yet ambiguous, and nobody knows that what is the, intention of the Reserve Bank of India. But from indirect sources, it has been, we hear that the intention is very clear that even though, you have partial investment in the AIF, you need to carry 100% provisioning on that. So it would result in a situation where in AIF has got 100 crore corpus and the banks have invested, and NBFCs and Bank on the Full Industry has invested, say 20 crores, but the full investment becomes tainted, and it could be that in the industry circle it could carry more provisioning than the full asset size itself. So therefore that's the intention, because AIFs are a structure where the Reserve Bank of India is not very comfortable with. So again, another area is on penalty. So this is the highlighted that why, what is the quantum of penalty and what are the instances that why penalty has been, besides cancellation of registration, license, surrendering of license, and before, suspension of business, also monetary policies are there also. So for housing finance companies are 4 instances, but for NBFC, there were 37 instances, and the highest maximum penalty crores were about 7 crore penalty as far as, were concerned. And these are the reasons why the penalty were levied. So just laid down, we can read what was the failure, what happened that these penalties were levied as far as NBFCs were concerned. So I think so with this, I conclude my session. I think so I've concluded just in time, and maybe, I hope that you all found this 90 minutes intriguing and interesting, and I hope it was some value added to you all. Thank you.
Thank you, Manishji, for an excellent session. We have a few questions asked by our participants. So I'll just read out to you.
Sure.
Am I audible, Manishji?
Yeah. Yes, I can hear.
Yeah. So the first question is how NBFC can control NPA?
So it's a very generic question that the NPA can be controlled first and foremost thing by having a robust underwriting process. So when you are evaluating a loan, you need to have a robust system, and it's a very generic question, so a very generic answer that I'm given. But if it has to be seen that if that NBFC is into infrastructure financing, then what is the end use monitoring that they are doing? What is the purpose of the loan? What is the background of the promoters? What is the track record of the company? What is the project that is investing? So all these evaluation needs a thorough investigation or a thorough strong process around it. And if you are giving a loan to a retail say for example, now there are many Bajaj loans which are there. You go across and you go to a Chroma, you buy an expensive phone of 1 lakh of rupees, and immediately you have these offers, where you can convert it into. Then what is the track record? What is the credit history of the borrower that you are taking? Because there he won't have, an income tax return file or whatever. Only his credit score, CIBIL score, which is there, will be able to be tell you. And plus, what is happening is that many large institutions, NBFCs, are having programs wherein they collect from these account aggregators my history of my spend, what is my credit card spend, what is my, say, if I've taken a housing loan, if I've taken a car loan, what is my income status. So therefore these various models are available within themselves itself. And these models are run, and even RBI is looking at it, that if you are giving loans purely on these models, then how, have you done a sanity check on these models? How accurate are your models? How accurate results these models are throwing out? So therefore, I believe that first and foremost thing, your underwriting process and how you manage your risk of going wrong is more important. And NPAs can happen because of fraud also. So how robust is your policy as far as controlling fraud is there? Because right now you see a lot of online frauds, where your PAN number is used, your phone, cyber frauds, everything. The unimaginable, there are controls are there, but more than control, there are imaginary ways of perpetrating this fraud. So how strong your underwriting process is there, that's the only way you can control. And just to add to the question also, there is once the account becomes a bad or an NPA, it's very difficult to recover the loan. Is as far as, if it's a housing loan, yes, the culture is that koi ghar nahi beche dega, they will try to do something, they will try to sell the ornaments, etc., and try to give the loan. But if it's an unsecured loan, somebody, if you're given a car loan, within one day, the car comes out of the showroom and the 2 lakhs value of that car only falls down. You bought a 15 lakhs car, and if you want to sell it the next day, you will not get 12, 13 lakhs. Like that case. And RBI is also very strict in the recovery agents because of harassment cases we have heard, repossessioning of assets, etc. So that becomes difficult. So that's how I think so. Basically your underwriting process will help you how your NPAs can be controlled.
Okay, thanks, Manishji. The second question follows: can a non-deposit taking NBFC obtain deposit from first shareholders and second relatives of directors?
Yes, because deposit taking only talks about the public deposits, and as per the Companies Act, if it can take loans from the related parties, holding companies, etc., from directors also, subject to that section 56, it can take compliance of 56. Only from public there is a restriction.
Okay.
So naturally, those processes they will have to follow. That the directors are from its own funds and not from any borrowed funds, etc. All that requirements which are there of Section 56 will have to be taken care of.
Okay, great. The third is there any restriction to maximum interest rate on loans given by NBFCs?
Yes, there are. Even as far as MFI are concerned, there are these maximum loans. Right now, I'm not aware, but yes, there are restrictions on MFI loans, etc.
Okay. The next one is, there's an example. There is a company which meets the financial asset and financial income criteria, but the required NOF, that is net owned funds, is not met. Can such company be considered as NBFC, not required to be registered, or will they be considered as a regular private limited company?
Yeah, so this is it does not have a simple jacket answer to it. You also have to see that yes, has it continuously breaching the 50-50 criteria? Is it carrying out financial activities? Like for example, either is it giving loans, or is it giving loans to related parties, or is it giving loans and recovering interest? Or the example that I gave you in the beginning of the year, that it had never an intention to carry out these activities, but in 1 or 2 years, because the rental income stopped, or something happened, it breached the 50-50 criteria. But if the intention of the company always is to invest in mutual funds or carry out these financial activities, and it has not taken approval from the Reserve Bank of India, and it is not meeting the net own worth criteria, then it's a serious non-compliance. It cannot do that. That's the thing. Say, for example, now suppose if you take my example only, suppose me and my family members and my friends, suppose all of us come together and we say that, okay, let us not invest, in mutual funds and invest in shares on our own name. We will invest in a private limited company, and all the money we will bring in, and from that private limited company, we will invest. No, that we cannot do unless and until we register, have the net worth funds, etc., and then get into that, in that way. So I hope that answers the question.
Yeah, just following this same question, sir, I would like to ask you if there is a company which is not doing any business, okay, and they have only a few assets in that, basically loans and advances, and they are earning any interest income on that. So in this case, such a company by default, it falls under an NBFC.
So as I told you that yes, if they are doing that, then it would fall unless and until it has loans and see, if it breaks 50-50 criteria as far as income is also concerned, then definitely it will fall. So as an auditor, you will have to report that this is an NBFC, but it is not registered, and you have to rectify that position. So what you can do is either recover that loan and put it in a bank fixed deposit. Bank fixed deposits are not considered as financial activity.
Okay.
So, yeah, if this is there, then yes, it becomes a problem. So even though if you have a holding company and holding company gives a loan and it does not have any operations, then it is a risk of construed as NBFC also is there. Even though it's not intention to carry out any NBFC activities.
So even if such a loan is given to a private party, then
Yes.
also.
Yes, that risk is there. So naturally, I'm assuming that it does not fit into the net own fund criteria, but it is breaching the 50-50 rule. That's what I'm assuming to give the answer.
Okay, and so we have to rightly report that in Caro, right?
Yes, yes, yes. And the management is responsible to get. So if RBI comes to it, then it might, have some penalty or some compounding on you. That may so happen. But in the other, the many a times what happens is that if they have some group companies just to break the 50-50 as far as income is concerned, they take some consulting income from some group company so that, suppose if, say, for example, in that particular year, 25 lakhs is the interest income. So they take a consulting income of 30 lakhs from some group company or something like that, rental income, etc. So therefore, as far as asset is concerned, they might be breaching that, but as far as income is concerned, then they don't breach that 50-50 criteria, because the requirement is that for registering or for considering to be an NBFC, you have to breach the 50-50 criteria on both sides, the income side also and asset side also. If you are not 50-50 in any of one, then you are out, then you are safe.
Okay, fair enough. The next question which comes is whether a firm can form an NBFC without accepting deposit or loan from public. Any registration with RBI is required for the same?
A firm cannot carry out. That's what I said. It has to be a company. If you want to carry out the business of NBFC, it has to be a company. But firm, you cannot. The RBI will not register.
Okay. Is internal audit applicable to all the NBFCs, or there is an exemption limit for base layer NBFC?
There is an exemption layer, and also as far as Companies Act is concerned, then you'll have to follow the Companies Act requirement for appointment of internal auditor or the requirement of internal auditor. So if you are applicable for the Companies Act, just now I don't exactly remember, but there is a criteria for internal audit applicability as far as Companies Act is concerned. Then it would be required.
Okay. And I suppose the last question which follows, whether a non-taking deposit firm financing vehicles, trade advances to small traders require registration with RBI?
So it's a partnership firm that is doing this business.
Maybe they have not specified this, but we can assume that.
Or the simple answer is that if a company is doing it, then it cannot do financing activities.
Okay. Correct. Yes, sir. So we have received so far so many questions. We have actually Manish sir has addressed all these quite efficiently, and now I would like to propose a hearty vote of thanks to you, sir, on behalf of our Professional Development Committee of ICAI, and I would sincerely express my gratitude to Chuk sir also, uh, and the other members, the technical team, Priya, and not to forget the participants. Sir, we have a huge number of participants. We had almost 1,000+ participants today for our seminar.
Thank you.
So it's been a great, grand success for all of us. And I hope the members are fairly and definitely enlightened about all the NBFC provisions and the professional opportunities that you have briefed upon. So it was a very indeed a nice, fruitful, and enlightening session for all of us. So thanks a lot once again from all of our team, the Professional Development Committee and ICI, and we'd definitely like to hear you again in the forthcoming meetings.
Thank you.
Thank you, sir. Thank you, one and everyone, for attending this and making it a huge success.
Thank you, everyone. Thank you. Thank you, Priya, madam. Thank you, Sachin.
Yeah.
Thank you, sir.
Yeah.